Good evening, viewers. You're watching the Mortgage Busters show, and we're all about helping you pay down your mortgage as quickly as possible. We bring on the right people to talk to you and show you how to pay it down in record time. My name's Greg.
I'm Adrian.
And Adrian, help me. I'm drowning.
What
I'm
happened?
drowning.
What's
I'm
happening?
drowning in 1,000-day Mortgage Buster Challenge inquiries.
It's insane.
It's going insane.
It's
Every-
insane.
From week to week. We keep mentioning it, but
Every day our call centre's getting...
yeah, we're getting slammed with inquiries for the Mortgage Busters Challenge, which is pay as much of your mortgage down as you can within 1,000 days. In fact, what we try and do is get the whole lot, pay down under 1,000 days. We had Chris Bondon in a few weeks ago. He did it in 973 days. I got money on my mind. He did it in 973 days. He's actually writing a book about it right now, but we had him on the show. Check it out. Go to our YouTube site or our YouTube channel, whatever it is. Check out the episode with Chris Bondon in it, and he explains on that video what he went through to make it happen. But we're going to make it as easy as possible for you.
That's right. Another
Exciting.
guru.
Another guru. Very exciting. We've got Dale Sinnott back on the show again. We had him on the other week, and he's back again through popular demand. There's still a couple of questions I didn't get to ask him, so here's my chance. Dale, welcome back to the show.
Thanks for having me, Greg.
It's been great. The response we had on our last show with you on it was very good. It went really well, and we had a lot of inquiries.
Fantastic.
So welcome back. Thanks for taking the time out. My first question, which was the last time we met, I wanted to ask you, but we ran out of time. We get a lot of inquiry about capital gains. Can you give us a definitive answer on when capital gains is due, when it's at what value, at what rate, all that sort of stuff?
Absolutely. Okay, Greg, capital gains is basically when you sell the property for more than what you acquired it for in the original part. So let's say if you bought a property for $250,000 and then you sold it for $300,000, you would make a capital gain of $50,000. And the government, being the government, they would like to have a share of that capital gain for taxation purposes.
Of course.
So we have to pay some tax on it. So basically, if you buy and sell a property within 12-month period, that full $50,000 from our example is subject to tax at your normal personal income tax rates. There's no discount if you sell within the first 12 months.
So does that mean if I'm earning $70,000 a year and I make $50,000 on the property, does that mean I'm still only taxed on $70,000, or it's $120,000?
It's $120,000 you are taxed on.
Okay.
And so the $50,000 is taxed at your personal tax rate. So in that situation, 30%.
But that might get me to the next tax bracket.
Correct.
Yeah,
And that's where you have to be careful.
Okay.
So sometimes if you're right on that 12-month period, sometimes it's better to hold on to that property till you go over the 12-month period.
I see.
And also the thing to remember in relation to that 12-month period is relation to the timing, is that for capital gains tax purposes, the capital gains tax event for the sale of property happens on the date you sign the contract, not on when you settle.
Oh, wowie. On the date.
On the date
On
you
the
sign the
date. So
contract.
you have a 1-year settlement.
Mm-hmm.
Yeah, correct.
Oh,
So if you sign the contract in June and it doesn't settle until July or August, you are taxed in that June year because that's when you signed the contract.
Yeah, but Adrian's right. Sometimes you can have a 12
yeah,
months.
we're buying stuff
You know?
on 12 months.
Yeah, 12 months.
Absolutely.
Oh, that's interesting.
I never heard that one
I'm glad
before.
we got you on the show.
I better ask the accountant next time.
Exactly. Look, there are structures in relation to contracts and things like that where you can delay it, but in a general, normal contract that the mum and dads are looking at, it's the date of the contract.
Why is that?
Is
How
the
does that
capital
make it-
gains tax event.
Wow.
Okay. And then?
And then, well, if we sell it after a 12-month period, then the government says, you're being good people, you've held it for more than 12 months, so we're going to discount the capital gain that you need to put into your tax return. So we go back to our example, we've got a $50,000 capital gain, we only have to put $25,000 in on our taxable income. So therefore, we go back to your example, Greg, $70,000 plus $25,000 capital gain. Their taxable income is, of course,
So it goes down
$95,000.
half every year? Or
No, it's just a one-off, Adrian.
Oh,
It's
that's
just
it.
50% on the capital gain.
Even
After
if you
12
held it
months.
for 10 years.
Correct.
And what's the rate? How much is the capital gain?
There is no capital gain tax rate because basically what happens,
right.
it comes back to your personal tax rate.
Yeah.
But what we always say to our clients when they ring up and say, we're thinking about selling the property, what sort of capital gains tax are we looking at? We say, look, your worst case scenario is that 23, 24% of the capital gain would be subject to tax. So what does that mean? If you're in the top tax bracket, bringing into account the discount, you're looking at losing around about 1/4 of your capital gain, worst case scenario.
Right.
Well, that sounds
So if
good.
you're in a lower tax bracket, it drops back.
Okay. Okay. Did you have another
So
question?
it's not the longer the better, is it?
No.
Because I think a lot of people thought the longer the better.
Originally, that was the situation
Okay, that's
because
where
that
that
was
came
back when
from.
we had indexation.
How long- that
But
was-
the indexation's very rarely used these days in relation because you either choose the indexation methodology or you choose the 50% discount methodology, and the 50% discount always gives you, in most
better.
situations, would give you a better tax outcome.
So as an accountant, do you interrogate the client as to why they're selling? Is that part of your what you do?
Not really, but what we really want to make sure is that if the client has a capital gain, is what we need to do to minimise the tax aspect of that capital gain.
Right.
So it's about, is there any other ways that we can reduce their taxable income over the future period before the end of the taxable year so that we can reduce the effect of that capital gain. So should they be salary sacrificing? Should they be putting more money into superannuation? Should they go out and buy another property and prepay the interest on that loan? Things like that. So it's about,
Prepay interest.
correct,
Okay.
you know,
Oh, yeah.
it's about finding ways that we can reduce their taxable income so to minimise the tax effect of the capital gain is what we really want to do. Because we're hoping that the client is selling for a commercial reason
Right.
and they're making money. And that's the number one thing is you want your clients to make money out of this transaction. What we want to do is just save as much tax as possible.
Absolutely. And job's done.
Correct.
Dale, we have to go to another break, but
No
we'll be
problem at
back
all.
straight after.
Great, thanks, Greg.
You're watching the Mortgage Busters show. We'll be back straight after this break. Welcome back, viewers, to the Mortgage Busters show. We're with Dale Sinnott from Larkin Partners Accountants in Kew. Dale, capital gains.
Yes,
we
Greg.
just talked about it before the break. So the main point there is you should really try and hold an investment, whether it's a property or shares or whatever, for that minimum of 12 months.
Correct.
So that you make that capital gains saving.
Absolutely. That 50% discount is a great benefit, one of the few benefits that we're offered with through the tax legislation. So if you can hold it for more than 12 months, absolutely.
Yeah, okay. And it's taxed at your own personal tax rate, whatever
Correct.
that is.
Correct.
Okay. Another one. And I've seen a lot of advertising on the internet, in the papers, on TV especially, about Smurfs, about self-managed super fund. Self-managed super funds. Can you give us an overview on self-managed super funds?
Yeah, look, what a new process that's come through over the last couple of years is now self-managed super funds have the ability to borrow to buy property or other
shares?
investments
Yeah.
through what's called a non-recourse facility. And what a non-recourse facility means is that the borrowing entity, the bank, can only claim against that asset, not against the other assets of the superannuation fund. So if you've got, if you're borrowing to buy a property, it can only, and for some unknown reason there's a default on that property and the bank wants to claim it back, it can only claim back against that property. It cannot access your other assets.
Do you know that that's the best explanation I've ever received on what a non-recourse loan is? It's
that
actually
was-
quite
and it was-
simple. I understood
And it was quick.
Yeah, it was quick. Yeah.
I can make it go for longer if you
No,
want,
no,
Adrian.
no, we'll take that version, thanks. Now, I actually know what it is now, so thanks for that. Okay, fair enough, so, and go on.
Yep, so basically the main advantage of using a self-managed superannuation fund is the tax advantage. In relation to our income, it's only taxed in a superannuation fund at 15%. So once our property is positively geared, it's only going to make it's only going to get taxed at 15% rather than at our personal tax rates, which may be range from 15 up to 46%. So that's the number one advantage.
Okay.
The second advantage is in relation to the capital gain. If we sell that property before we retire, our capital gains tax rate in a self-managed super fund is 10%. If we sell it after we retire, our capital gain under current legislation is 0.
I like that.
Oh,
Under
that's
current
attractive.
legislation.
That is very attractive. Yeah, current. When it's going to change.
It's going to go to 50%.
But even 10% is more attractive than the standard capital gains rate.
It is very
Yeah.
attractive, and for most of our income earners, what they can do is, if they're in the right position, is they can salary sacrifice additional money into the self-managed super fund, which is basically giving them the same benefit as what a negative geared property would in their own name. So basically,
Right.
we're reducing their income by putting additional monies into the super fund, and that helps us to fund the shortfall of their property that they acquire in the fund, and giving them a little bit of tax advantage in their own name as well.
But there is actually a big chance of them having a positive cash flow, because if they've got 200 grand
Mm-hmm.
and they buy a 400 grand,
Mhm.
it's going to be cash positive.
Positive.
That's right, and it's cash positive
And
in a
that's
low
great
tax
for
environment.
all reasons,
Yeah,
isn't
low
it?
tax environment. That's the important thing.
Yeah.
Some people, I think,
Best way to use it.
you know, when
Utilise.
we've helped people, we've got a specialist that helps people with self-managed super funds on request.
Mm-hmm.
And I've seen him in action, and quite often, you know, you can see that the clients, they're not sure they actually believe that you can create your own super fund. You know, because they think they have to go to that one that, you know, that thing, whatever it is, you know, or one of those big industry funds, you know.
Yep.
Well, that's all there was
But-
until now.
Yeah, until now. Yeah, but now you've got as much right to have your own super fund as any industry fund.
Absolutely.
take
Look,
control of
the
your-
self-managed super fund industry is one of the strongest growing industries that we have in the financial environment, and it's a complicated instrument, but it's a simple one if needs be. So. If you've got the right advisors behind you, so we would say that you need to have a financial planner sit down and make sure this is the appropriate vehicle for you to be doing your investment with, number one. And number two is having an accountant there that can look after the accounting work in relation to the self-managed super fund as well. But at the end of the day, it's like any other investment, is that as long as you've got the priorities right of it earning the right amount of income, the borrowings is the right amount, the location is right, the commercialisation is right, then at the end of the day, the self-managed super fund will assist in reducing your tax.
So you've got, at Larkin and Partners, you've got the facility to do all that sort of
Absolutely.
thing? Okay, fantastic.
What about commercial? Do they do it with commercial as well?
Absolutely,
Yeah.
absolutely. In fact, probably a lot of our major business clients all acquire their business premises through self-managed
So
superannuation
they're actually
funds.
allowed to claim their own, because there's something here. If you purchase your own,
Residential.
you can't
You
rent
cannot.
it to yourself or your
Yep.
family.
Absolutely, that's a good point, Adrian. Is one of the things that you cannot do under a self-managed super fund is buy a property and live in it yourself. This must be rented out to an arm's length third party, so it can't even be rented out to
Cousin,
one of your
nobody.
children or uncle or auntie or anybody like that.
Yep.
It must be totally arm's length. And also, a self-managed super fund cannot buy residential property off an associated person
Wow.
to the fund as well. So, you know, which is one of those things, is that if I'm in business and I've got a business property, my self-managed super fund can buy my business property, but it can't buy my residential property.
Any
Where's
reason?
the,
Where's the logic?
What's the logic there?
Oh, there's none.
Do you know of it, or do you know?
Look, I can't think of any specific reason why, except that I think it's just really just making sure that everything is arm's length.
Yeah,
That you're not, that the member of the fund cannot get any personal benefit out of the fund whilst they're still in accumulation mode.
Yeah, right. Understood.
Okay,
Dale, we've come to the end of our time again, but
No.
it's been most valuable for myself and Adrian alone, let alone the viewers watching.
Yep.
So thanks for coming back, and I'm sure we'll have you back again at some time.
No problems, my
So-
pleasure, Greg. Thanks, Adrian.
Thank you.
So if you'd like to speak to Dale or have a consultation at Larkin and Partners, just go straight to our website, which is
www.tmbshow.com.au.
tmbshow.com.au, and just register your interest there, and we'll get you in touch with Dale Sinnott from Larkin and Partners. Thanks for watching Mortgage Busters Show. We'll be back with Steve Hudson, our finance
Guru.
guru. Stay tuned. Welcome back to the Mortgage Busters show. We're with Steve Hudson, our finance guru.
G'day guys, how are we?
G'day,
Gee, I tell you what, that 1,000-day Mortgage Busters challenge has been
busting the phones.
Yeah, well, it's been enormous.
Maybe we should do a 500-day Mortgage Buster challenge as well.
Oh, we could do that.
No, I'm just joking. 1,000 days is plenty.
That's a bit
I
off.
think we've got enough work
it's a
on
bit off
already.
bit off the cuff. We could probably work something out for the viewers. No problem at all. On that.
No, 1,000 days is bringing in a lot of interest, and that's what we want, is for people to take control of their finances, not be at the mercy of the bank, and the interest rate drops and rises. And, we're all expecting interest rates to start going up again sooner or later. Never a better time to take control of your mortgage right now and pay it down as quickly as possible.
Absolutely, Greg.
So, we talked about Smurfs.
With Dale.
Self-managed
Yeah,
super
you
funds.
did. Self-managed super funds. Smurfs, what a great name for a structure, isn't it? Eh?
For something so
Whoever came up with that
legal.
idea was brilliant. So. Yeah, look,
Thinking of a
yeah.
broom,
What I'd like to do again, with from a loan point of view, just to get an understanding with the structure for that. It's just not a plain, simple, easy set up a self-managed super fund, knock on the door of a bank, and say, I want to buy this property.
It can't be more complicated than your Telstra mobile phone bill, could it? It couldn't be.
Yeah.
Anyway.
Yeah. So look, what I want to do is talk about some of the actual contributions that you can make to a self-managed super fund. And before we go ahead, I'm not a financial planner, so I can't give financial advice. We're talking in general terms here. Any of the viewers that wish to pursue this, I would say that they register on the website for what we talk about, and we can get one of our guys who are financial planners that we have association with, talk to them.
Absolutely.
So that's the non-disclosure.
Call the 1-300 number.
So some of the with the contributions to a self-managed super fund, or to any fund really, you could, there's non-concessional and concessional. Concessional is tax-free. This is what the employer pays. If that's $10,000, you can actually make another salary sacrifice or a contribution which is tax-free of another 20. So currently under the ATO ruling, you can make a contribution of $30,000. Don't forget, any money going into a self-managed super fund is taxed at a very low rate.
What's the employer giving now? Is it 10%, 9%?
No, it's 9.5% climbing.
Okay.
I think Uncle Joe has made some changes to what was going to happen. They've put some dates out, so they're changing all the time. But you're allowed to make up to $30,000.
And it's a sacrifice.
Yeah, it's a sacrifice. You're not paying tax on your personal rate.
These
The words are good, aren't they?
Yeah, it's like
No wonder
it
nobody
involves
gets
pain.
it.
It's
Nobody
a pain.
understands it.
Yeah. They couldn't call it something else. They have to call it a sacrifice.
It could be a saving.
Oh, I think we're sacrificing tax, so it's a sacrifice to the government.
Yeah.
But you can also make additional payments above that of $180,000 a year. So that's money that you've already paid tax on, and you can roll up 3 years into one contribution. So 3 times 180 is $540,000 in one hit.
You could, but you couldn't do it again for another 3 years.
That's correct. Yeah. So that's just gone up this financial year from 150. So there is then, if you're buying a property in a self-managed super fund, you've also got the rent that goes into the fund, which is taxed. And then you can use those fundings to actually then go and buy a property besides the equity that you need. Okay.
Can you direct the rent anywhere, or of course it has to be back into the super fund?
Back into the super fund.
That's a ruling.
Yeah, it's a rule.
Okay.
You can't use it for your own personal gain in any way. It's there for setting you up for retirement. That's what the one ruling is. So let's just have a quick look of a structure. How
The whiteboard.
the whiteboard.
Friendly whiteboard.
So with a self-managed super fund, or Smurfs as we like to call them at the Mortgage Busters show, is that you set up your fund, your self-managed super fund here, which is a trust, a unit trust of some type. Then you have a trustee. Now, a trustee can be an individual, or it can be what they call a corporate. So you register a company, so Price Limited. Okay.
What's preferred?
Well, where if you're buying a property, the preferred is a corporate, Price Limited. So some banks will not allow you to borrow if you're an individual trustee.
Well, there you go.
So corporate. So you've got to have that set up. So these are the important things of just running out and setting up your own self-managed super fund. The other thing is the trust deed on your self-managed super fund has to be set up in a certain way for you to borrow. So the banks give your copy of your trust to a solicitor, and they check it to make sure it ticks all the boxes for what the bank wants, okay? And if it doesn't tick those boxes, they'll come back to you say to change your trust. So that will cost you money. So it's better off to get it set up correctly in the first place.
Yeah.
Now, Neil was talking about non-recourse borrowing. So
Dale? Dale.
Yeah, Dale, sorry.
Dale.
Yeah,
That's okay.
Dale. Now, the self-managed super fund is not allowed to directly borrow the money. There is a ruling, there's a 10% ruling that they can only borrow up to 10%. So what is set up is another trust, which is called a bear trust. There's other names for it, but there's nothing in there. All it does is hold your property, okay, where the non-recourse loan is going to be, okay? So that owns this property, not the self-managed super fund.
Yep.
Now with banks, depending on the lender, most lenders want 20% deposit. In some cases, it might be more, okay, or equity. So the self-managed super fund must have equity of at least 20% to buy a property, and then they're also, quite often, they'll say we want an extra amount. It could be in cold hard dollars. Some banks want a $50,000 cash left in there, or they may want a 20% situation left, or 30%. But each bank is different. Okay, so and it comes back to this: there are some lenders that will allow individuals, but the majority is price limited.
So besides the purchase of the property or shares or whatever it is, there's got to be some left over for
Insurances, if for loss of job.
Yep.
So if you've got a loss of job situation, you're not going to be making those contributions the way they were, so they want to see that is set up correctly.
Sure.
In some cases, the bank will want to see the actual insurances. And very quickly, once that's paid off and you've paid that property off, the property then goes into the ownership of the self-managed super fund, and the bear trust then is distinguished.
And it'll be a much better fund having some property in there and cash and a bit of diversification
and I would
than a lot of funds these days. Steve, not much time left for chit chat, but again, we're running out of time very quickly. So thanks very much for watching the Mortgage Busters show. We're loving your support. We're loving your inquiries. Stay tuned again, same time next week. Have a great week from Steve, Adrian and myself. Thanks for watching the Mortgage Busters show.